Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into a filing from Endeavour Group Holdings. And let me tell you, this one's about as exciting as watching paint dry or maybe watching someone else take out a loan. But don't worry, we'll make it interesting, or at least try to. Endeavour, the entertainment and sports giant behind things like the UFC and talent agencies, just filed an 8K report. This is basically a quick update they have to give to investors about important events. In this case, it's about them borrowing more money. So let's break down what's happening, what it means, and why you might care. First things first, what's this report even about? It's about an agreement to borrow a significant amount of money. More specifically, it's about an amendment or change to an existing loan agreement. This loan agreement, called the Margin Loan Agreement, involves January Capital Holdco, a subsidiary controlled by Endeavour, borrowing money from lenders. Now, this isn't a brand new loan. They actually had a loan agreement dating back to September of last year, but they just changed it. Think of it like this. You have a credit card and you call the bank to increase your credit limit. That's essentially what Endeavour did here, but on a much, much larger scale. So what exactly did they change? On March 12th of this year, they entered into something called the Second Amendment. This Second Amendment basically increased the size of the loan they could take out, bringing the total to $3.0. That's a lot of zeros. They went ahead and borrowed the remaining $1.25 billion that was available after the change. One thing to note is that they didn't have to put up any additional assets as collateral for this extra borrowing. Collateral is what you promise to give the lender if you can't pay back the money, like a house for a mortgage. In this case, they didn't need to add more to what they'd already promised. The report says that all the other important conditions of the original loan agreement stay the same. So the interest rate, repayment schedule, and other fine print are basically unchanged. Because they borrowed so much money, the report mentions a financial obligation. This is just a fancy way of saying they owe a lot of money. Now, you might be wondering why a company like Endeavour needs to borrow so much money. Well, it could be for a variety of reasons. Maybe they're planning an acquisition, which is when they buy another company. Maybe they're investing in new projects or expanding their existing businesses, or maybe they just need the cash to cover their day-to-day operations. Unfortunately, this report doesn't say exactly what they plan to use the money for. So what's the big picture here? Endeavour has increased its borrowing capacity and taken on a significant amount of debt. This could be a sign of growth and expansion, or it could be a sign that they're facing financial challenges. Without more information, it's hard to say for sure, but it's definitely something to keep an eye on. The level of their debt in the future can be something to consider. Now, let's shift gears and talk about what this all means for you. If you're an investor in Endeavour, this news might give you pause. Debt can be a double-edged sword. On one hand, it can fuel growth and increase profits. On the other hand, it can also increase risk and put a strain on the company's finances. If Endeavour is successful in using this borrowed money to generate more revenue and profits, then the increased debt could be a good thing. But if they struggle to repay the debt, or if interest rates rise, it could lead to financial trouble. Even if you're not an investor, this story is still relevant. Endeavour is a major player in the entertainment and sports industry, and its financial decisions can have a ripple effect throughout the entire sector. Now, let's get to my take on Endeavour and this debt situation. Endeavour at its core is in the business of experiences. They own valuable assets like the UFC and operate a massive talent representation business. These are strong positions in growing markets. However, the entertainment industry is also notoriously fickle and competitive. Trends change rapidly, and what's hot today could be old news tomorrow. The biggest risk I see with Endeavour is their debt load. While using debt to fuel growth can be smart, too much debt can cripple a company, especially if the business hits a rough patch. Endeavour needs to demonstrate that it can effectively manage this debt and generate sufficient cash flow to meet its obligations. The increase to $3 billion is quite alarming and might signify they are not handling money well. Also, Endeavour operates in an industry heavily reliant on talent. Losing key talent or facing increased competition for talent could significantly impact their revenue and profitability. Overall, I see Endeavour as a company with a lot of potential, but also with significant risks. The success they will have will heavily rely on their ability to manage their debt. Thanks for watching. If you found this helpful, please consider subscribing, liking, and commenting.